Hey, Steve Saretsky here. As always, this is the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. The Saretsky report for November 2018, which is essentially a comprehensive analysis, overview of the Vancouver real estate market, all my charts, graphs, data that I'm looking at, things to look at, etc., is all in one PDF format. There's a link to that below where you can go and read it for free. And of course, if you want, you have the option to subscribe for free and get each month's report. So I encourage you to check that out. I know there's been really positive feedback on that to date. So hopefully you get some value out of that. I want to provide a quick sort of macro overview, things that happened over the past week, and then we'll dive into the Vancouver real estate market stats for all of November, break them down, etc. First and foremost, the Bank of Canada held interest rates firm. They've actually turned very dovish. Basically, now the market is pricing their possibility of them hiking rates in January went from 60% down to 10%. And you know, this turn of direction, turn of momentum is really quite something, and it sort of entails a lot of the thoughts in the video and my thought process behind a lot of these videos. Is again, it ultimately comes down to financial education. And so when I say that, I try to put that into context in the terms of, you always hear on sort of mainstream news and through the economists, bank economists, etc., always painting this rosy picture of a strong economy. We're going to continue to have higher interest rates because there's this tremendous, fascinating growth. But here we are, 10 years into an economic expansion. You have the unemployment rate now at a 42-year low in Canada. And despite that, you're still running a negative interest rate 10 years later. And the fact that you can't even get to 2% without something starting to break really just shows you, how sick the underlying economy really is. That, this growth narrative and the strength narrative, when again you're running this cheap monetary policy, you can't even hit 2% with something breaking. Really sort of underlies my thesis that I think people need to be paying attention to. So, I don't know where the Bank of Canada goes from here. It'll be interesting to watch the Federal Reserve. Obviously, they've had a change in directions recently as well, but it's a simple fact that you have a massive runoff in the Federal Reserve's balance sheet of quantitative. They're now inducing quantitative tightening along with interest rate hikes, and the global economy simply can't withstand that. And so that's why you're seeing central banks pull off. That does not mean, I had people asking me, does this mean that real estate prices are going to go back up because the interest rates are no longer going up? That's really not how these systems work. Generally what happens is central banks, from a historical context, hike interest rates to a point where things start to wobble. They then hit the pause button. That's generally followed by a recession, and then they ultimately start cutting rates. So the fact that they've paused is actually, in my opinion, concerning. You've seen part of the yield curve invert as well. So these will all be things to watch moving forward. Just looking at some of the data that came out, it talked about unemployment in Canada at a 42-year low, and still this is where interest rates are. Despite that data coming out, the wage growth in Canada actually decelerated for the 6th consecutive month. So you now have wage growth at 1.5% growth year over year. Now you think about that. That means your wage growth is growing below the inflation rate. So when you adjust for inflation, it's actually negative wage growth. And this makes, when your interest rates have been rising as they have been, this makes servicing your debt that much more difficult when wage growth starts to decelerate. And this is a very important thing that I've talked about in terms of your debt service ratio, something Ray Dalio talks about, and one's ability to service debts. It's okay to accumulate credit in this low interest rate environment, but then as soon as the interest rates go up and as soon as your wage growth starts to slow, that's when you run into debt serviceability problems, etc. So watching that, people have been talking about the stress test. We're moving that. Interesting because I got into a debate with, actually not necessarily debate, with Mortgage Professionals Canada, and they were basically lobbying to Evan Siddall, CMHC, the CEO, that, you know, hey, we need to remove the stress test because it's hurting these poor millennials. But what they don't understand is if you actually watch Evan Siddall's playbook, this is a guy that used to work in the Bank of Canada. If you actually listen to what he says and the resources that he talks about in the book House of Debt, which I've mentioned numerous times in this, he's basically laying out his framework for his viewpoints on the world and why he's doing what he's doing. That has nothing to do with helping millennials. What he's trying to do is basically curb household indebtedness. He's trying to curb home price growth, and he doesn't care if that hurts millennials from entering the housing market. It's really about ensuring financial stability and ensuring that you can have long-term economic growth. And you can't have long-term economic growth with a huge mountain of debt. And it's essentially reaching a point where it's like pushing on a string. There's just nothing there left to do. And so it's funny because, you know, Evan Siddall actually tweeted me and Mortgage Professionals Canada back, which I was kind of surprised, basically saying that, again, this was, you can go look it up if you want to look at my Twitter accounts, at Steve Saretsky. I retweeted what he said. But he basically came out and said, our goal is to curb this runaway home price inflation and ease systemic risk. Our quote unquote, our job is not yet done. So a very aggressive stance for a regulator to come out and say, which is one of the things that I found. I'm actually surprised he hasn't deleted the tweet, because for a regulator that can, I think he has the ability to move markets with the amount of mortgages that CMHC are insuring and securitizing. You know, very interesting for a regulator to then come out and just basically squash the idea of, you know, removing a stress test. Anyways, moving forward into the Vancouver market data. It's essentially a continuation of the trend. As I mentioned, real estate markets are very slow moving. Once a trend is in place, it tends to stay in place for much longer than one can anticipate. You know, the detached housing market, this again for the city of Vancouver is very similar. Everything I give you for the city of Vancouver is very similar to Greater Vancouver as a whole. City of Vancouver detached home sales, 10-year low again for the month of November. This is pretty much a continuation of the trend. If you look at single-family home sales now, year to date, so that's taking January to the end of November, and compare that back on historical level, you have detached home sales have never been this weak in the history of the city of Vancouver. That's as far back as my data goes. So again, that's like we now have an 11-month period of really weak detached home sales. And that has really started to push prices down. I've talked about that there's no perfect price metric. Single family homes are very much different lot sizes. Very hard to quantify to an exact percentage what the decline is in the detached housing market, because you see some homes that are selling 25% below what they would sell for at the peak, and then you have some that are only maybe 10% or 11% or 12%. So it's very, but if you want to look at you know, an MLS benchmark price, which I've told you many times is a lagging indicator, that's now showing that the detached prices in the city of Vancouver are down 8.5% from last year. You know, so again, if you look at, I like to use the 3-month moving average for the detached market. I think that's been a pretty good, accurate. You can see that it basically went down, came back up, and has now been going down. If you look at that from a peak to trough, it's showing about 18% decline. I think that's roughly in line. I would say most of those declines, again, are in the higher up you go. But I would say, you know, something to take note of for the detached housing market is that the new listings are down. I think they were down 25% from last year. I believe they're below historical averages. And so that really just shows to me that there's really isn't any panic from home sellers. You're not seeing, you know, a rush to the exits, people panicking to sell. That really is reflective in the new listing numbers. You're seeing inventory is basically stabilized. It is high. It is above the 10-year average. But it's more a result of just ultra weak sales. So again, and I think that's based, a lot of that has to do with sort of your macro conditions. Again, we've talked about Canada in a 42-year record low unemployment rate. There's really not a whole lot of reason for people to be hitting the panic button. Certainly there are people doing it for whatever reasons, divorces, estate sales, people that need to move out of the country, etc. And that's where you're getting some of the fire sales and honestly some huge discounts on the asking prices. But I think that's important to understand into the detached housing market. So, but there's no question that where volumes are, that there's likely to be continued downwards pressure in that market. Condo markets, this may come as a surprise to some, but it's something I've been talking about for quite some time, is the weakness is really starting to show up in the condo market. For November, you had a 10-year low for the month of November in the city of Vancouver home sales. I think they dropped like 46% year over year. Inventory up 76%. And so it's a huge change in the direction for the Vancouver condo market. But that was really no surprise. Having the detached housing market, really been in a weak market now for 2 years, when a lot of first-time buyers are dependent on mom and dad to tap home equity or help them with their down payment. If mom and dad's house is going down in value, all of a sudden that makes it much more difficult for first-time buyers to get into the market. But it's also like, if you see detached prices coming down, like particularly on the west side, 20%, all of a sudden it doesn't make as much sense to be, paying a record high price for a 2-bedroom condo. So it's all relative, and what we're basically seeing is the detached market is finally compressed and pushing down on the condo market. So that will be something to watch for moving forward. But again, I wouldn't say huge shifts. Again, I've talked about real estate is so slow moving, so people that expect a 10% drop in the next 3 or 4 months, it's just not really how real estate markets work. Just so slow moving. There's still a lot of people, particularly sellers, that are really in denial with where the market is at. But I think the sales volumes really speak for itself, and the fact that the sales volumes are where they're at, when you have an unemployment rate at a 42-year low, is certainly concerning, because it's inevitable that unemployment rate will begin to rise. It really can't go any lower. When you're at this stage in the cycle, it is going to rise, and there's a close relationship between the unemployment rate and the growth of credit, and we've seen mortgage credit growth slip to an 18-year low. And again, credit growth is essentially a function of demand. When credit is growing, there's essentially less demand. You're basically creating, we can see that in the money supply as well. That's starting to decelerate as well. So those are all signals of a tighter financial market. So yeah, again, that's all we have for this week. I wouldn't expect much to change moving forward here in the December. I think the thing that really fascinates me is how the central bank and Canadian policymakers are going to shift here moving forward. How the banks are going to react. We've seen the 5-year bond yield, which is basically tied to the 5-year fixed rate, has been plunging. Will banks begin to adjust mortgage rates lower? Begs the question. I think that there's certainly a risk premium that they're trying to build in, so I'm not sure that we should expect too much of a decline in the 5-year fixed borrowing rate. Just last week, I'm told that TD Bank, which has been leading the charge on the home equity lines of credit stress testing, is now basically turning off the taps on construction draw financing. If you don't know what that is, it's generally a financing that someone who would use for, say, a single family home. You want to build a single family home. What you'll do is, maybe you pay all cash for the land. When the bank says, hey, great, you want to build a house? Sure, we'll give you the loan for $1 million. But the bank doesn't just give you the $1 million up front. They basically stagger those payments based on your progress in the construction. So they might give you $200,000 once the concrete is poured. It might give you another 300,000 once the framing is up, et cetera, et cetera, et cetera. So now they're shutting that off. So that's just another signal of banks tightening up. So it'll be very interesting to see how that stuff all progresses here moving forward, because I think we are at a very interesting tipping point where the narrative from the central banks and the Bank of Canada just 2 months ago was, we're going to hike. We are going to get to 2.5 to 3.5%, to all of a sudden things start to wobble. And, you know, here we are less than 2 months later, and it's a complete reversal of, oops, we're actually going to hit the pause button, looks like, and we might have gone too far. Oops. So, anyways, that's all I got for this week. Otherwise, see you soon.